Hi, I'm Jonathan Berk, AG Giannini Professor of Finance, the Graduate School of Business at Stanford University, and I'm here to talk about a joint paper that I have with Jules van Binsbergen on the impact of impact investing. So the question we thought about was, what is the impact of a divestiture strategy? If you choose to divest yourself, let's say oil stocks, what impact does that have? So the first question you have to think about is, why would somebody choosing to sell their stocks impact the corporation at all? And the truth is, indirectly, it has no impact. I mean, who owns the stock doesn't directly affect how the corporation does business. When you sell, you just sell to somebody else. So the question is, what about an indirect effect? Now, you can think of two indirect effects. The first indirect effect is when you change ownership, you change people's preferences, and some people might have preferences to exercise their rights of corporate control. So they could think about running proxy contests or trying to get themselves elected to the board of directors to change the policy of the company. But the problem is, the investor selling is the person who cares about the environment, and they sell to another investor. It's hard to see how selling would increase the probability of environmentalists affecting the policy of the firm through the rights of control. So if that isn't affecting the social outcome, the only other way of affecting is what we call the cost of capital effect. And this is how that works. When you sell your stock to somebody else, you have to induce that person into buying the stock. And the way you induce somebody into buying the stock is you lower the price. So when a socially conscious investor sells their stake in a company, in order to induce somebody else to buy the company, they have to offer a lower price. What that means is that raises the cost of capital for the firm, because the lower price essentially means the firm has to pay a higher return for new capital. And so in the long term, what that means is, if you raise the cost of capital, holding all else equal, what that means is the firm has less investment opportunities. A higher cost of capital means less net present value investment opportunities. And so the firms that are sold have less investment opportunities, they grow slower. Similarly, the firms that the socially conscious investors buys, the opposite happens. It raises the price, it lowers the cost of capital, and so those firms have better investment opportunities. And so over the long term, the socially desirable firms grow faster than the socially undesirable firms, therefore lowering the amount of social costs in the economy. So that's the indirect way in which a divestiture strategy can affect social outcomes. But the key thing to realize here is, in order for the strategy to work, the cost of capital has to change. And so the question today is, how much does the cost of capital change if socially conscious investors follow a divestiture strategy? So in the paper, we calculate the effects on the cost of capital, and we come up with this approximation. It's a very good approximation to the effect, and the advantage of this approximation is very simple. The effect of the cost of capital of a divestiture strategy is a product of four terms. The first term is the market risk premium, and that calibrates it, because the market risk premium is a measure of the overall market return. And you multiply the market risk premium by three factors. The first factor is the fraction of dirty stocks in the economy. The second factor is the ratio of socially conscious investors to other investors in the economy. And the third factor is 1 minus the correlation coefficient squared. Why is the correlation coefficient in there? The reason the correlation coefficient is in there is it measures the substitutability of stocks. The way to think about this is, when you sell, you have to induce another buyer to buy. If stocks are highly substitutable, you won't have to lower the price by much in order to get that investor to buy. If the stocks are not substitutable, then this investor is going to have to compromise a lot, and therefore you're going to have to see a big price change. And what determines the substitutability of stocks? It's the correlation between stocks. So when investors follow a diversification strategy, they care about how highly correlated stocks are. And so that's where the correlation coefficient comes from. So if you calibrate these numbers to the measurable numbers in the economy, so you use a market risk premium of 6%, which is relatively high. The fraction of ESG investors in the economy is 2%. So 98% people are not ESG investors. The fraction of dirty stocks is 48.5%. And the typical correlation between a dirty stock and a clean stock is 0.97. If you put those in, you get an effect of 0.35 basis points. So absolutely minute effect. So the conclusion of the paper then is that a divestment strategy is unlikely to affect firm investment strategy. The effect is just too small. You could also ask the question is, how many ESG, how many socially conscious investors would it take in order for there to be a significant effect? So if you think that you need about a 1% effect on the cost of capital to change corporate strategy, and as you can see in this curve, you need over 80% of investors to be socially conscious in order to have an effect, which I would say is a pretty optimistic number, that you'd ever get 80% of investors to care that much about their investment strategy. Finally, we verified this empirically by just doing the following. We looked the FTSE has a FTSE US index, and they also have a FTSE for Good index. The for Good index is the subset of stocks in the FTSE US index that are deemed socially good. And so what we looked for was whether or not there was an effect when a stock was included in the for Good index or excluded from the for Good index. Again, you would expect that if you wanted to see socially conscious investors want to have a big effect, you would need to see a big price change. You'd need to see a big inducement when they choose to sell or they choose to buy. And so we look for that. And what you can see is the price change is very, very small. It's 6 basis points right here. And remember, on the previous slide, what we were calculating is the difference in the cost of capital. And the price change is the capitalized value of the cost of capital. So a 6 basis point change in the price is in the same order of magnitude as a 0.35 basis point change in the cost of capital. Either way, the effect is very, very small. And so I guess our conclusion is that if socially conscious investors want to have an effect on the firm, rather than divest, they should invest. And by investing, use their rights of control to change corporate policy. Obviously, if you focus on just a few firms, you would need far less than 80% of investors to affect corporate change. I mean, even if you have a large enough minority stake, is often big enough to affect corporate change. So that if you really want to affect corporate change, it's a far better policy to invest and change corporate policy rather than divest and give up your rights to change corporate policy.